Well, Telstra has been an absolutely appalling stock for most of its life as a privatised company, but on Friday it plumbed new depths when its share price hit $2.82, the lowest ever. There was a flurry of broker downgrades in the wake of this week's disappointing profit announcement, and CEO David Thodey's forecast of a high single-digit fall in profit next year. I spoke to one of the analysts who have dramatically cut their price targets, Ian Martin from RBS. Well, Ian, you had Telstra as a buy at about 3.30, and now it's a hold at 2.95, so you've downgraded it. So did you get it wrong and didn't see coming what happened on Thursday?
We certainly didn't see it coming. The temptation to spend some of that free cash flow that the company's been targeting for the last 5 years, the temptation to spend that to help rebuild their market position in mobile and in fixed line was just too tempting for the company. Perhaps we should have seen it, but we didn't see it. There's no obvious catalyst coming up until they get that strategy and explain it and demonstrate that it's going to work. There's just no obvious catalysts in the
But you weren't alone in sort of not picking that up. I mean, virtually the entire market didn't see it coming. I mean, is everyone angry now at Telstra for not foreshadowing, not keeping everyone informed?
Well, there's a degree of anger, if you like, but there's more a sense of confusion and is this the right strategy? Or would it have been better to spread that spending over a number of years to manage the EBITDA margin instead of just taking it down in one step from 44% to 40%, perhaps manage it down over 4 years? That needs to be explained. The strategy they've got to spend money in 1 year to try and build that margin back up in the following years is just too far out and too opaque for the market to buy at this stage.
I mean, you mentioned in your report that you were particularly disappointed that they weren't able to find costs, other reductions in costs to pay for the investment that they need to make in growing customers. I mean, they've already started cutting costs. What else should they do?
Telstra have been talking about managing down their resources to reflect the change in their business. That's been the talk out of the company for many, many months, and indeed right through the transformation, that as we got to the final years of transformation, we would see that resource base come down and we go through a period of good cash flow. But instead of getting the benefit of that coming out of the transformation, we're now going into another mini transformation, if you like.
Do you think they're panicking?
I don't think they're panicking. I think this is quite a deliberate strategy. It's not necessarily voluntary, but it's quite definite, quite deliberate, that this is, in their point of view, the best way forward to deal with the market structure as it is.
Well, they have to do something, don't they? I mean, the decline in the PSTN is accelerating. It's not just kind of a steady decline, it's actually starting to get away from them, isn't it?
Potentially. The decline in the PSTN has been coming for 6 years. It's been going on for 6 years.
By which we mean the public switch telephone network. I should perhaps explain that. But yes, the decline in the ordinary phone network is really declining.
Yes, it's been declining since it peaked at about 8.2, 8.3 billion in 2004. So it's been quite a steady rate of decline. In fact, it's a bit lower this year than in previous years. But what's interesting now is that the decline has really accelerated in calling rates. Particularly local calls down 14-15% and long-distance calls down 10%. And that begs the question, if people aren't using their phones for calling anymore, are we now going to start to see the rate of switch-off of lines accelerate?
What's driving that, do you think, that people not using their phones to call anymore?
There's two things. The main one, of course, is that mobile growth has been has accelerated. And as people are using mobiles and getting more and more value out of mobiles, using it for things like internet access, they're also now using it more and more for calls. And of course we've had a lot of competition in mobile packages in the last year. Telstra's now met the market with its $49 cap and its $79 cap. So the expectation is that what we've seen in terms of migration from fixed to mobile will probably step up a notch in the year ahead.
And how much of your $3.60 value now on Telstra is accounted for by the $11 billion they get for the NBN deal?
It's around about 20%. So it's quite an important component to get that. I believe the $9 billion of the 11 that comes from NBN is a guaranteed amount, and there's another $2 billion in offsets. But that looks more attractive now, given that it's a relatively known amount, a relatively reliable amount, whereas the alternative to that is that you've got a decline in cash flow that is very hard to forecast.
Well, in fact, to some extent, the company becomes a renter of infrastructure to the government business, NBN.
That's right.
I mean, that's a pretty steady cash flow, just collecting the rent.
That's right. That's right. It's a nice business to be in if you've got the infrastructure.
So should shareholders be angry with the government over the NBN, as they were still, or should they be more angry with the management and the board for stuffing things up.
Yeah, I don't think there's much point being angry either way. It doesn't help as a shareholder. I mean, you've just got to look logically what's happening in the industry, what the government may or may not do. So that whatever justification there was for being angry a year ago at the new legislation, all put into place now if that deal goes ahead. They've got to weigh up the deal, of course, early next year. No point being angry with management. Management are what they are.
What are they?
It would have been nice to get a greater share of that cash flow, but they've got to weigh up, is this the right strategy? And listen to what Telstra's saying. We'll hear more about that at their Investor Day at the end of September, and we'll see over the next 12 months whether that strategy starts to pay off and whether it offers some greater dividends in future years.
You've got a 360 valuation on it. At what price would it be a buy?
We've got a 360 valuation. Our price target, 12-month price target, is 324. So there's a 10% discount to the valuation, and that's because there's no obvious catalyst to drive that share price towards its valuation, at least until we get to the NBN deal sometime next year.
Thanks for joining us, Ian.
Thank you, Alan.